So who controls all of our money? The origin of money is a question that is rarely asked or taught in schools, even though it plays a significant role in people's lives. Most people dedicate their lives to earning money, yet very few understand where it comes from and who controls it. In fact, money does not come from the government, and its source is often a mystery to many. While people may sense that something is amiss with the financial system, they are unable to pinpoint the issue. In 1694, following 50 years of war, the English government sought loans to support its political activities. Scottish banker William Paterson proposed the creation of a privately owned bank that could generate money out of thin air to lend to the government. This led to the establishment of the first modern central banking system in the world. Central banking wields significant influence, yet it is not a focal point for the general public. Moving to the early 20th century, a group of bankers made two unsuccessful attempts to establish a central bank in the United States. In December 1910, Senator Nelson Aldrich, accompanied by six others, clandestinely boarded a private train car in New York bound for Jekyll Island off the coast of Georgia. Over 9 days, they devised the Federal Reserve System. The group included banking leaders, government officials from the Treasury, and some of the wealthiest individuals of the time. To illustrate their wealth, these six men collectively represented a quarter of the world's worth in 1910. The bankers presented the Federal Reserve System as a means to stabilize the economy and curb the influence of Wall Street banks over America. The problem was that the people who wrote the bill were the same ones they claimed they would stop. If they succeeded, it would give a small group of men the ability to create money from nothing and loan it to the American government with interest. So why was it done in secret? Because the American people didn't want a central bank. Back then, unlike today, people understood what central banks were and their potential effects very well. Wherever a central bank was established, there would be wealth inequality and unpredictable economic ups and downs. After each economic downturn, the wealthy seemed to get richer, while everyone else became poorer. Europe was a clear example of this at the time. The Federal Reserve was originally proposed as the Aldrich Bill, but when it reached Congress, they recognized Senator Aldrich's name and became suspicious. The bankers needed better cover, so they decided to send two millionaire friends to present the bill. The Federal Reserve Act was initially named to quell Congress's suspicions. The bankers aimed to deceive both Congress and the American people. They used disinformation in newspapers, protesting against the new Federal Reserve Bill, claiming it would ruin the banks. This led the public to unknowingly support a bill that actually limited the bankers' power. The bill was passed on December 23, 1913, while most of Congress was on holiday, giving a small group complete monopoly over the issuance and creation of American money. The Federal Reserve is now the most powerful entity in the United States. The former Fed chairman, Alan Greenspan, stated that the Federal Reserve is an independent agency and cannot be overruled by any other government agency. The Fed has extended $9 trillion in credit, yet no one at the Federal Reserve, including the Inspector General, is keeping track of this. This information is relevant to everyone, as the central banking model has been implemented in most countries, unifying them under one economic policy. Suspiciously included Afghanistan, Iraq, and Libya. And number 2, since the end of World War II, the US dollar has been the reserve currency of the world. You could predict what prices were going to be. You could start a business elsewhere. You could calculate profits. Business was much easier before floating exchange rates. Unfortunately, in 1971, due to a falling US dollar, international capital flows into gold, and the funding of the Vietnam War, President Nixon took the US dollar off the gold standard. I have directed Secretary Connolly to suspend temporarily the convertibility of the dollar into gold or other reserve assets. Now the dollar was floating and backed by nothing and has been ever since. So let's think a little. If the US dollar is backed by nothing but the world reserves are backed by the US dollar intrinsically since 1971, doesn't this mean that all currencies are now backed by nothing tangible, only trust in the American government? Well, this is correct. Money backed by nothing is known as fiat currency. Fiat in Latin means let it be done. In other words, the government says it is money, so it is. A consequence to having money backed by nothing is that whenever the Federal Reserve creates money, it dilutes the currency supply of all other nations because their reserves are backed by the US dollar. All countries' reserves are worth less each time money is created. In the past few years, the Federal Reserve has printed trillions of dollars, and countries like Russia and China have noticed this. As a reaction to the money printing, these countries have been selling US dollar reserves and buying gold over the same period. But wait a second. Some of you clever thinkers out there may have asked yourselves, the current economic system operates on faith, where currency holds its value based on the trust that it can be exchanged for goods and services. Most of the money supply is managed by central banks, like the Federal Reserve in the United States. When the government needs more money, they borrow from the Federal Reserve. The interesting part is that the money the Federal Reserve lends is created out of thin air. They simply invent it. This process also happens at commercial banks, where new money is created each time they make a loan. This system has consequences. When more money is created, the value of existing money decreases, leading to inflation. This means that over time, prices of goods and services increase. Additionally, the system encourages debt, as more borrowing leads to more money in circulation. It's quite a peculiar system, and it affects us all. Central banks control the money supply and interest rates, influencing the economy in significant ways. If you found this video helpful, don't forget to like, share, and subscribe for more insightful content. Until next time, happy investing!